Check. What's up, Jake?
Hey, Mark, how's it going, man?
Good. I can't hear you.
Nah, I can't hear myself.
Is that better?
Hello?
Oh.
Hey.
Hey, the
Coming
world
at you
opened
live.
up. How you guys doing over there? So I thought we'd Facebook Live this. I don't even know. Is that a verb? I thought we'd FBL it.
FBL it, yeah. Acronyms today. That should be the name of the podcast, all about acronyms.
So if you guys don't know, this dude over here, this handsome devil to my right, is our financial analyst here at Dental Success Institute, Mr. Jake Conway. We've been working on lots of really cool stuff. Today we're going to be talking about income allocation. He is a common or a very frequent guest on the podcast, so we thought we would record a podcast episode. And since we share an office, we thought that maybe we would just FBL it.
FBL it.
All right.
That's going to go viral.
So here we go. All right. The topic today is income allocation and what you do with the cash that comes in. It actually is it is a really, really common question that we get
all the time
from not just our clients, but from people outside of DSI wondering how to allocate towards debt, how to allocate towards savings, how to ensure that you're covered as far as taxes go and all that stuff.
Yes, exactly. All the time. So I'm sure most of you may know, we run Customer Practice Analytics, which is the product that myself and Mark uses to analyze your overhead, your profitability, all that good stuff. But as we start to save money and drive overhead down, obviously profitability increases. We've gotten a lot of questions on, okay, now I'm, my overhead is under 50%. I have all this cash in the bank. How do I start allocating all these funds that make sense for not only myself but for the business and tax implications, all that good stuff. So I feel like we've simplified it pretty well at this time to really, for all you do-it-yourselfers out there, you can take some of these methods that we've developed. I mean, this kind of came out of thin air, but it was a culmination of all the years and practices that we've seen, right? So like all that knowledge that we have, I think we've quickly identified that this is a pretty helpful and digestible 5 to 6 step process that will really make a big difference on where to put your money and how to allocate funds so it makes sense to you.
I like it. So you ready to go ahead and start recording?
Sure.
All right. Here we go. Ready?
Yeah.
Hello, everyone, and welcome to another episode of the Dentalpreneur Podcast. I'm your host, Dr. Mark Costas, and sitting next to me here is a handsome devil named Jake Conway. Today, we're going to be talking about something that sounds super boring.
It does.
Super unsexy. But believe it or not, this is one of the most common questions that we get, and that is what to do with your income. So welcome to the podcast, Jake Conway.
Thank you, man.
Yeah. So how often do we get the question, very simple question, all right, you guys, we sent in our P&Ls, we sent in our balance sheets, you guys have generated this customized practice analytics scorecard for me. You say that I'm X dollars profitable. Where the heck is the money?
Right.
There's no money left.
All the time.
I thought my scorecard was awesome. You said that my overhead was 56% this month, which is down 3%, and there's still no money in the account. So what say you about those sorts of questions? Where could things be?
Yeah, first would be look at what you're drawing as an owner. That's a good place to start. See exactly what you're drawing, what's your W-2, all that good stuff, what that looks like in relation to your revenue. But also is debt service. We talked about that a lot.
Mm-hmm.
What debt do you have, including your interest each month, and how is that affecting your true take home? Because so many people look at those top production, collection, expenses, and then profit, right? Like that's kind of the bouncing ball that they use, but they don't take it one step further to look at their business debt, and I would even throw in the personal debt as well to see what the true implications of that debt is to your personal income.
Yeah,
so
and cash flow, and personal cash flow.
Right.
So that's one side of the coin. We hear,
Correct.
Where is my money?
Correct.
And then we have the other side of the coin is I have this windfall, or you guys are doing a great job. We're decreasing our overhead. There's an excess of cash now. Do I just get super aggressive and pay down like my CVCT loan? Do I get super aggressive and put it towards my student loan debt
401k
immediately?
or
Should
whatever.
I try to pay off my house in 9 years?
Yeah.
Do I maximize my qualified funds and put a bunch of the stuff towards my 401k or my
Roth,
retirement
yeah.
accounts? Do I buy an income property? What do I do with all this cash? And I mean, it happened enough times, and we got enough of the same question over and over again that we started saying, we need to put a formal process together for this.
Right.
So we've created this thing called kind of an income allocation cheat sheet,
Yeah.
for lack of a better term. And there's certain things that we like to see happen before people get super aggressive about paying down debt, super aggressive about getting exotic with their investments. Of course, all these things are really, really great things. We want you to be aggressive and get eventually to a no debt status,
right.
and we want you to have as much retirement savings as possible. But we do believe that there are certain steps that you should actually walk through to make it really, really practical. And one of those things, obviously, is making sure that you're setting aside the appropriate amount of money for taxes.
Correct.
That's
right.
a biggie. That's
right.
a biggie. I mean, geez, I've made the mistake so many times where my CPA and I have underestimated what my tax liability is going to be for a given year, or we've overestimated or underestimated the amount of income that we were actually going to have for a year, and we totally missed the mark on the amount of savings, the amount of money that we had to set aside for our tax bill for that particular year. So why don't we just talk about, how much should you have in savings? How much liquidity should you have? How much should you set aside for, sorry about that, how much you should set aside for, so taxes,
Safety net.
Yeah, safety net for the practices. So let's just go through the list.
Yeah.
I mean, we don't know it enough to have it all totally memorized, but I love this topic of allocating extra funds.
Right.
So go for it.
And so I want to preface this of, we're not CPAs. We're not telling you how to allocate your money when it comes to tax purposes. This is just a guide to give you options and make it so that you set yourself up for basically no surprises, and you have cash in the bank in a strategic way. Right,
Mm-hmm.
it's more strategy than anything. So I just want to preface that. So, if your bank accounts are sitting $1 million, that's great for you. This is just a way to make sure that you're allocating those funds correctly, so that you don't get hit with any surprises. So
okay, yeah. So we have. I mean, our thing is that you and I have been talking the same language for a lot of different years, but we never had official names for this thing. So
Sure.
The first thing that we came up with was income allocation cheat sheet, which is super lame, and we'll come up with a better name, but that's basically it. I like to see a certain amount of money in what I call a safety net for the dental practice in an ideal scenario, right?
Yeah. So let's go through the accounts if you're cool with that.
Mm-hmm.
We set up. I think we've identified real simple 4 accounts that you can set up today to get this process rolling. Very simple to do.
And you're talking about separate actual business accounts.
Correct.
Some being savings accounts, some being checking accounts.
Correct.
Yeah, go for it.
So the first one is the operating account, which we've identified this as. I mean, this is the account that you're going to be paying your fixed and variable cost to the business each month, right?
Okay.
We've identified a threshold and phases with that. So you avid listeners, that in our coaching methods we have phase 1, 2, and 3. Well, now we actually have phase 1 or 0 through 3 when it comes to building up these accounts. Mm-hmm. And that first account that we're talking about, operating account. Again, these are the different phases. So phase 1 would be between 0 to less than 1 times of your fixed and variable cost. So what do I mean by that? So that's basically your what we're calling the MBE, right? Today is a day of acronyms. So MBE, monthly break-even point. So
Okay.
Monthly break-even point, I guess I'll back up and identify that. Monthly break-even point, as we see it, is your overhead, fixed and variable cost,
Mm-hmm.
plus what you pay yourself as the owner, whether that's through W-2 or draws, whatever that is, plus associates. Of course, if you have associate doctors, that's included, plus your debt, which that's a big key to this. So overhead, doctor income, owner and associate, and your debt service each month, including interest.
So this is separate, completely separate from overhead. That's a totally separate formula. So we're
Correct.
talking about everything that you need to pay in the practice before there's any excess cash.
Correct.
Right?
Correct.
So we call that the monthly break-even point. Some people call it the BAM, the bare ass minimum. Some people call it different things.
Right.
So whatever your break-even point is, Okay, back to the formula. So phase 0 would be
between 0 and less than 1 of that. So if you're basically living paycheck to paycheck per se, you know, just each month you have to have collection just to make payroll. Yeah. We consider that phase 0. So we build to that next phase. So the next phase would be, you know, 1 to 1.5 times your of that break even point. So if once, you know, as you start making more money, you're decreasing your overhead, your profitability starts to increase. We want to see that this account to, you know, at least operating at 1 to 1.5 times that in phase 1, right? Okay. Phase 2 is 1.5 to 2 times. So again, same principles, same calculations. Phase 3, which that's the ultimate holy grail here, that would be two plus of that MBE, monthly break-even point.
Yeah. So okay, let's just say that your break-even point is $75,000 for $100,000 total adjusted production.
Right.
Okay. So you have or collections. So you have $100,000 collections, and your MBE is $75,000. Right. Okay. So we want you to have, as a safety net, at least $75,000 in total funds in some sort of a savings account. You can go all the way up to 2 times that. It's not absolutely necessary, but you can go all the way up to 2 times that as a safety measure, just a place to keep some cash just in case anything catastrophic happens. Now, you guys have to keep in mind, I know that sounds like a lot of cash, right? $150,000 in your safety net account for the practice, in addition to what we're going to talk about for your personal finances. But the reason that we do that is because if you think about, you are covered, most of you guys hopefully are covered for insurance, right? You're covered for insurance just in case something happens to you, right? Disability insurance. And usually, and this has happened to me before too, I've had 2 back surgeries, and you usually don't get access to the insurance coverage until 90 days past the actual ceasing of work, right? So if something catastrophic happens, if you happen to get in an accident or you're disabled for whatever reason, you should be covered at some minimal degree with your disability insurance. But the more money that you can have set aside to bridge that gap, the better.
Absolutely. Okay. Absolutely.
So that is the reason that we came up with that figure. Now let's talk about from a personal finance perspective. I know that we're bouncing back and forth here, but let's talk about from a personal finance perspective. What have we identified as the ideal scenario so that you're safe as far as your personal expenses as well?
Right.
Because you're going to have a monthly break-even point for your personal expenses as well, right?
You should. Absolutely.
Right.
Absolutely.
So it's a really good idea to kind of have some sort of an idea. You know, I work with Ryan Isaac and Reese Harper. They're my financial advisors, and they're like, dude, you got to figure out exactly how much it is that you're spending every month as your break-even point for your personal finances. Right. How much is everything? How much is private school? How much is your clothing allowance? How much is your food allowance? How much is your
entertainment?
Your entertainment. All that stuff goes into kind of one lump sum, and that's what your break-even point is for your personal finances too. And what is the formula that we like to use for break-even point for personal finances? Your liquidity, your personal liquidity.
Yeah, so so many people don't, like, we do this for our businesses, right? But so few that I've seen actually don't do this for their personal finances as well. So this is, if you do this for your business, if you've done this before or have gone through this exercise, I recommend doing this for your personal finances as well. But to your point or to your question, Mark, that your personal finances will be all of that. Your mortgage, your debt, any debt associated, credit card payments. All these personal expenditures. And I would get really sophisticated and get drilled down to, what you're paying for utilities, like every single dime, and see if you can track every single expense that comes out of your personal checking, credit cards, whatever, to see exactly what that number is. Once you've identified that number, we propose that eventually, again, this is a phase. Eventually, at some point, we'd love to see you at 3 plus your personal finance break-even point. Yeah.
Okay. So if the typical, and I think I remember Reese and Ryan saying that the typical established dentist, their personal monthly overhead is between $16,000 and $18,000 a month. Okay. Let's just say your personal overhead is $16,000, $18,000 a month. Multiply that by 3, and that's what we'd like to see for you guys to have some sort of access to liquidity as far as a safety net in your personal savings. And then once you've kind of, this is really liberating. It may be bad news for some of you guys, but it's super liberating to know that if you have a goal in mind and there's an intention behind it, we want 2 times that operating expense, that break-even point for your practice, and we want 2 to 3 times your personal overhead as a safety net. Once you've funded those accounts, then you can have more fun and you can figure out where else to allocate that money, right?
Yeah, exactly.
Not necessarily fun yet. I'm sorry, I jumped to fun too fast, but
fun is just knowing, right?
Yeah,
that's what we're talking about.
Fun is knowing. It's just a peace of mind knowing that you're going to be okay if something catastrophic happens, if there's an emergency, if you break your hand in a flag football game, which I've done before. So continue on with the different accounts that we need to pay attention to.
The last one is in no particular order. Is the tax account, but this needs to be established, with
your CPA
with your CPA, but alongside of everything else we're talking about. I said this is probably one of the most important, so this account is basically just for any tax liabilities that obviously that you will see in the future, but this is just a way to take some of kind of that profit first method that we've talked about and really put that into action. So we're actually identified, and I've spoken to a few CPAs about this, this may seem high. This could be something you work towards if you're not comfortable with letting go and deploying some of this cash in this manner. But we like to see, or what we've identified is between 20 and 25% of your profit for that month after you've paid all expenses of that.
You're talking not profit. 20 to 25% of your total gross revenue.
No, profit.
Oh, profit.
Profit. Correct.
Okay, that's what the CPA just said.
Because that's where you'll be taxed on that net income.
That's right. Right. I'm sorry.
No, you're good.
I stand corrected. You're right.
If you could do that of your gross revenue, that'd be even better. But no, 20% of your net income, your profitability for that month will be allocated to this tax fund. Again, if you need to start small, start with 10% and then work into that, and then eventually you may get hit with a bit of a surprise and maybe lower, maybe higher, but at the bottom line, at the end of the day, you're going to have cash on hand strictly for taxes that you basically don't even see. So that's the whole methodology of that. So again, setting up these 4 accounts, you probably already have your operating account. Let's hope so.
Okay, let's just go over this. I don't have the piece of paper in front of me. So the operating account should be ideally at what percentage of your income?
So the operating account should be that 1 to 1.5 times your operating expenses.
Your gross revenue.
Yep. Of your gross revenue, I mean, we don't have a percentage set for that. It's basically whatever your hard dollar amount is for your MBE.
Your break-even point.
Yep. That's 1 to 1.5 times that. Again, that doesn't have to be. You can shoot for more, but we found that's sufficient.
Yep.
The next one is a business safety net, which is what we talked about, between 1 and 3 times your MBE.
I like that.
Right?
Yep.
So ultimately, we'd love to see 3 months worth of MBE in your safety net, because again, if something were to happen and you went over that mark, you have that safety net to ensure that you're going to be fine for the next 90 days, at the very least.
Mm-hmm. Nice.
Next is that tax account we just went over. So again, start small if you need to, but work your way up to 20 to 25% of your profitability.
Total profitability for the month. Yep.
For the month, right? And then that personal safety net, which went over that. So the first step there is identifying what your true expenses are.
Okay.
Dollar amount each month, personal expenses, and maybe even add on 5% to that, just for a little bit of fluff, or 10%, and say, okay, I have to bring home $20,000 a month. So I would say build up that safety net, which is a savings account, to ultimately 3+ that personal break even point.
Yeah, that's great. I mean, if you think about that, guys, if you're funding these accounts, you're funding your safety net, you're funding your operating account, you're funding your tax account, and you're funding your business safety net as well.
Mm-hmm.
After that, any excess cash beyond that, it's okay. You shouldn't feel guilty about deploying that to go on vacation, or to buy something nice for your spouse, or
invest,
or double down on investing, or making an extra payment on your mortgage, or whatever it happens to be. You guys have the discretion to do that, and knowing that those accounts are all safe. Your safety net accounts are all safe.
Exactly.
I love that.
Yeah.
It's just I've done it personally, and I have to say it is liberating to be able to fund all of those accounts, and then know that once those are all funded and taken care of every single month, you have to take a glance at 3 different accounts, make sure that you're maintaining those accounts every single month. Beyond that, you know that you can spend a little bit of money without guilt.
Absolutely. And, you know, the flip side of that, if you don't have the funds to do all this just yet, that's okay. Like the exercise of going through all this and knowing exactly what my break-even point is, exactly what my personal break-even is, just to know that in itself is liberating. Then, as you start to get more strategic with it and you start to really see these accounts grow, you know that all the profitability that you're seeing, you're allocating it in a strategic way, so it makes sense for you at the end of the year.
Yeah, and then that's when you can kind of ask the question, ask the personal question. If I'm super uncomfortable about debt, then you can kind of fill in like our debt sheet that says, okay, what do I want to tackle next on this debt sheet? Do I really want to focus hard on credit card debt? Then you start eliminating credit card debt. Do I really, really want to focus hard on my student loan debt? Because a couple of the pieces of the student loan debt might be higher interest rate.
I have a variable fixed rate, or variable rate that I want to get taken care of.
So then you start chunking away at those sorts of things, but not until after you fund all the safety nets.
Yeah, I would say at least get to phase one of all those. We kind of just covered briefly before you start looking at that. But ultimately, I mean, getting to 3 times in these separate category or these different accounts we just went over, I think that's the ultimate goal.
Love it. Thanks, brother.
Yeah, man. That's
all right.
Good.
Ladies and gentlemen, as always, our financial analyst here at DSI, Mr. Jay Conway.
Thank you.
All right, Facebook Live people, thank you. Take care. I hope you enjoy it. This will be out on the podcast probably about a week or so. Take care.
See you guys.